Good morning. We're excited for you guys to get started with WealthFluent, and we're going to kind of walk through things today. So WealthFluent is an independent platform that focuses on holistic lifetime wealth planning, portfolio optimization, and risk management. So we have analytics tools designed for advisors to provide collaborative lifetime net worth management for the unique circumstances and preferences of their clients. We include all the significant trade-offs within and in between lifetime spending and goals, savings, and expected net worth accumulation versus risk decisions. All the decisions in planning and strategic asset allocation must be solved for simultaneously. All the different factors matter. We have a portfolio optimization tool set that includes everything on the balance sheet. So all your liquid assets, all liabilities are treated, and they are represented in a current market value basis on your balance sheet. We have a one-click optimizer that you can use to match exposures to your benchmark and then see all the trades you need to meet your lifetime goals. And that's based on your preferences and what's going on in the market currently. So lifetime decisions are not static. We believe strongly that decisions are dynamic and the factors related to decisions are dynamic. These can occur in one's lifetime, at any point, in any circumstance. The outcomes and their goals matter, and the financial markets and what they're offering today and into the future affect that outcome. WealthFluent employs a lot of great tools. We bring in data from various pricing providers, and we provide insights to the users so that the user can focus on the most important thing, using WealthFluent as their financial decision-making companion. So how do we do all this? Well, we employ as much of the best of breed pieces of platforms out there. So we don't take credit cards. We do not handle authentication. We use Stripe for that, and we use Auth0. We host everything in Amazon securely, and we use open frameworks like Angular. We take the inputs during a nice onboarding process for all of the details about the person and their circumstance. This is personal. They add their personal goals, details on their financial life, then they add all of their accounts. And we do this with secure connections through Fingoal and Yodlee, and often utilizing the open banking standard. So connections and permissions around those connections are set up in a way where the user has control. We bring in all the account data and have the option to schedule and bring that in daily or weekly, and everything is modeled whether it's connected or not. So we're able to handle manually entry of all kinds of accounts, liabilities, pensions, and things that are not typically on a balance sheet. We bring in market data from the best providers. So we bring in from NASDAQ, AlphaVantage, and EOD historical data for pricing. We pull in treasury data, and we have all the details of all ETFs and mutual funds for Morningstar. So that is a key component of the WealthFluent risk analytics and WealthFluent analytics in general. So we're bringing in our own financial analytics that are proprietary based on all the information we've pulled in so far. We enrich those, and we do innovative modeling, and we do this with really smart infrastructure from Amazon. So we take all that and we put it together, and we provide a personalized financial decision-making companion. The main tool set there is a financial health monitor, lifetime planning system, and a portfolio optimization engine, and of course, expert market analysis. So we've tried to make things as easy as possible so that when you start a conversation with your new client, they have already onboarded to WealthFluent. They've entered in a huge amount of their details and their preferences and added all of their accounts so that you can have that conversation starting with value rather than collecting lots and lots of statements and trying to cobble that together. So they come through onboarding process where we get an investor profile, they add the members of their household, they start adding their financial goals and all their accounts, and then they get a task to share their workspace with the appropriate advisor. And they have access to lots of great educational materials. So you'll be able to work with clients in the workspace dashboard where you will be able to see all of your clients' workspaces, and then you'll be able to load that. And it's really, the load is essentially a takeover of all the tools in WealthFluent. And so you can see everything they see and they see everything you see. So transparency is paramount, and permissions are set by the asset holder as a user. And so if they don't want to have you see their transactions, rather, you won't see their transactions and how much they're spending on restaurants and gambling. So what we do here is make it super easy for them and getting them onboarded. And then you can jump between all of your different client workspaces easily. You can even create fictional workspaces if you have a model family or certain persona use cases of model portfolios you want to share. You're able to share that with all your clients. So the center, once you have most of your details in WealthFluent, is the dashboard and financial health monitor. So you get to see at a glance, at a high level, one place, your wealth plan, performance, understand where you are versus your benchmark, and see key market indicators, as VIX is huge, and the key indices and everything from various markets. So you're also able to see your counts here by either category type, institution, see a regular balance sheet, or group by tax status. And then the financial health monitor gives you the most important indicator of financial health, which is net worth and net worth over time. So you're able to see the client or yourself see, where they're doing holistically over time, can understand cash flows, look at expenses in the across the entire wealth portfolio. So you're able to understand what are expensive expense ratios, or what true yield looks like versus the benchmark. You're able to look at allocation and understand at a high level what the wealth portfolio is made of. So then, Dr. Khan, you want to talk about the lifetime planning system?
Yes, we're going to put all the things you mentioned together to make decisions in terms of lifetime wealth planning. The inputs are the financial goals that David mentioned, and we have a large variety of choices, and you just fill out a little form about your goals, when they're supposed to take place in time, and your profile. A really important part for retirement planning is your life expectancy and your health to compare to your cohorts. The life expectancy comes out of the Social Security tables. Net worth is what we're really trying to manage here. And in market value terms, we want to complete balance sheets of all assets and liabilities. All assets and liabilities are what defines wealth management. Unfortunately, a lot of these assets and liabilities are not being managed, or managed in conjunction with other assets and liabilities, or the final decision on net worth. And here we're going to consider all liquid and illiquid assets. Even though it's a totally illiquid asset is not tradable like your Social Security, your debt, you can change it from time to time, cash out or refinance. But for the time being, if you leave it as fixed, it still needs to be taken into account, because a mortgage is a bond, but it's a bond with moving in the opposite direction of your long bond positions that are in your asset accounts. So they need to be managed together. If you have a private business that you're not interested in selling, that's also an asset that, depending on its characteristics, for example, it's typically going to be a small cap value security. So you need less of those two attributes in the rest of your total portfolio than you otherwise would. Next page. Okay, what are the additional inputs we need to make all the trade-off decisions is what's available to you as a user in terms of opportunities from the financial markets, investment opportunities. So we need something that's forward-looking in terms of what's the capital markets offering, in terms of expectations and risk, the trade-off between expected wealth and its risk. We need forward-looking efficient frontiers to construct our dynamic probability distribution of net worth. Now, when we say frontiers plural, we mean at each instant in the future. Basically, we will work on monthly data. you will have a different efficient frontier. And forward-looking means we use forward views with forward rates of the yield curve and then the appropriate risk premiums on each asset. Now, when we have all this together, what's the output we want to expect? And you'll have those choices, is you'll have a frontier of opportunities, and you will select a long-term strategic asset allocation, or what we would call a plan benchmark, among various expected wealth versus risk trade-offs. And rather than a questionnaire or other means of finding a risk tolerance without knowing the compensation for that level of risk, you will choose among the various opportunities given all your current set of inputs for goals and savings and expenditures. You will come up with a plan with your own money, your own set of criteria, not a model portfolio, but a portfolio that fits your unique circumstance. In that process, you will be revealing your preference for the risk-return trade-off. And you will create the strategic asset allocation will be your plan benchmark. And from there, we will be able to say, how should you allocate your own assets and your own investment decisions to come as close as possible to that benchmark strategy? Next page. Here's a typical balance sheet in market value terms. So we have a home, that's a big asset, and it's part of your total wealth or net worth. We have brokerage account, we've got an IRA, we have a pension, we've got a private investment in ABC storage units, and another 401k, and a home mortgage. So we have the value of all your assets, all your liabilities, and the difference gives us your net worth. Now, what makes this process holistic is that we're including on it a pension. A pension is typically not put on a balance sheet because of the uncertainty associated with how long it's going to last. Same for Social Security, same for annuities. They're on an income statement, but they're all bonds. They're annuity type bonds, and they belong in your bond portfolio. So if you don't include these on balance sheet, you're going to end up being overweight bonds without realizing. Same thing for other assets like a private investment or ABC storage units here. That's not traded, but we know it's small cap. We know it's value investing. And that means in our final portfolio, in terms of liquid assets, we'll need less of small cap value. So we'll adjust. It's the same idea that if you have a K plan with lousy opportunities and very high risk and very uncomfortable in terms of the amount of expenses. So what you would do is take the least bad opportunity, probably an index fund. And since we're going to optimize across all accounts simultaneously, we will fill in the other aspects you need for your total portfolio with other investments in those accounts. So we can get closer to the plan strategic asset allocation most efficiently. And the home mortgage is another example that's not, it's on a book value balance sheet, but not in terms of optimization of including it as a short bond position. It belongs in your bond portfolio decision making. So it is typically the reverse, since it's a borrowing, that is, when rates go up, the value increases. While when rates go up on your long position, value decreases. So it's actually a hedge within your bond portfolio, but you need to use the right amount of your other bond positions to match up to get the net interest rate risk exposure that you want. Next page. Okay. Here's some example of a planning process. And notice we've circled the amount on the profile of net withdrawals in retirement of $500,000. Now, the user that's running this for their family is 44 and a half years old, good health condition, and a life expectancy of 85 years. The net worth coming from their total net worth is over $1 million here, and they intend to save towards the future $30,000 a year. These are all inputs. The retirement target for the main family member, that's the user here, is 66 years of age, and that's 21 and a half years from now in 2046. Tail risk is saying, let's see where we would land if it happened to be in the worst possible 5% of outcomes. We'll also show you the top 5% of outcomes, and in both cases, their expected values conditional on being in those tails. We'll call the top upside potential and the bottom downside risk. And we'll also include taxes. The best thing to use is effective tax rate. And an example of that that you might get from either your accountant doing your taxes is, what is the total taxes paid divided by the total taxable income? What you should do here, since you have assets that are taxable and not taxable, is redefine your own effective tax rate as total taxes paid divided by total income from all sources, taxable and non-taxable. And by using that in your projections, you will have about the same ratio of taxable, non-taxable throughout. And we give you a choice of using a different tax rate effectively prior to retirement and another choice after retirement. Most people, if they manage their taxes well, will be in a lower tax bracket after retirement. Okay, so the graph that you see above is conditional upon all your goals, which are listed below, with the probability of success of reaching each of those goals. Now, it's kind of pretty easy to see with over $1 million in net worth that the first 4 goals there are pretty easy to obtain. Okay, it will get tougher for the larger numbers for retirement and what you may end up with in your portfolio at the end of the last retirement. That could be part of what you're thinking about for a bequest motive. And what is the probability of reaching that? Now, in the graph above, we're showing you the green line is expected wealth, and we have deviations from that. At each point in time, there's actually a whole probability distribution of outcomes with the upward 5% and the lower 5%, the downside risk. One of the major questions one would ask is, well, if I'm planning for retirement, the question is, how much do I need for retirement when I enter it? How much can I spend? Well, I put it in reverse here. How much do you want to spend? And then how much do you need at retirement to be able to do that? And how long will it last? So what we're projecting here after retirement is, what's the downside risk? Well, that's usually a big concern. And with a 5% tail risk, you're actually running out of money 27.3 years before the end of retirement. That's not good, unless you're comfortable with that 5% of risk. You have a choice in tail risks to make it 1% and be more conservative. You can make it 25 and 15 different levels. When one is younger, they can take on more risk because they can recover. But we want to manage that recovery if it should happen. We don't want to hit 0. In our dynamic planning methods, if you're heading towards that red line at 50 years old, when you're starting to meet some of your tough education and wedding goals for your kids, then you might shift to a less risky strategy till you get past that. And then depending on what path occurs, if it's going up, then you might switch to a more risk-return favorable strategy. But that is going to depend on what the market is offering at every point in time in the future, which you don't know now. but need to think about planning ahead for those possibilities. So this is an example of what typically happens when you're given a questionnaire and you're evaluated on your risk tolerance alone. They can put you in a bucket for growth, and you get a model portfolio for growth on managing your liquid asset portfolio, not taking into account where else you have wealth or obligations, as well as thinking about what alternative compensation I get for different levels of risk. That's where people should be making their decisions. So let's go to the next slide and say, okay, growth was terrible for me. I can't take that risk of running out of money 20 some odd years before the end of retirement and before I even start retirement. Well, look, I could go down to a very low risk strategy called preservation. And preservation is fine for getting through those early goals and maybe even make it to retirement, which is very likely here, even the second retirement. But if I want to withdraw $500,000 a year after that, I'm going to run out of money and net worth will be zero when I'm only 72 years old. Well, that's not a great plan. And the reason why this turns out so badly, and you can see the probability of success at the end is zero to make that $550,000 goal. And it's obviously one of two things are happening here. One is my portfolio at this level of preservation is not earning enough to meet my goals, or one of my goals is way too high and unrealistic, withdrawing $500,000 a year for the whole length of retirement. Okay, so let's try and modify both and go to the next slide, and we bring it down to 300,000. And we move it up to be tilted towards moderate risk, between lower and moderate, with 36% conservative and 64% moderate. And it looks like we're making all my goals with a high percentage, not running out of money, but maybe only having a much smaller amount at the end for my heirs. That's a plan. It's the individual's choice that might be very reasonable. Now, where this comes from is the fact that the efficient frontier you're drawing from has two characteristics not normally added. One is a riskless rate, so that you get a combination of riskless rate and an optimal risky portfolio and can move up and down that line for your preferences. But that's a single period model. Here we have a lifetime model of many frontiers, and in real terms after inflation, for your personal consumption bucket, there is no riskless asset. So we have to deal with just a risky frontier. Now, the lowest risk asset might be a money market fund, but you still have reinvestment risk. What it's yielding today could be very different next year. So you can't keep that as a constant. In fact, your best projection is a forward rate for a year from now for 1 month. So once you have a risky efficient frontier, and we have this characteristic that if we don't have a riskless asset, we experiencing diminishing expected return per unit risk. So when we show the growth, when you go from moderate to growth, what is happening? You're reducing the amount of expected return per unit risk. So you're eventually climbing that frontier and getting very little additional expected return or compensation for a lot of risk. So you don't necessarily want, and in fact, in the limit, you're investing in one security with the highest expected return at the far right for high risk or aggressive or very aggressive. That's the end point. So that's a poorly diversified portfolio with a lot of risk. You wouldn't want to be there. So you know the opportunity set is good, very good. You get a lot of compensation for moving from the lowest preservation strategy for an incremental amount of risk. And that works pretty well into the moderate range. And then it starts tailing off in terms of compensation. So your risk is expanding faster than your expected return. So the right place for you depends on what all your goals are, your unique retirement circumstances, your unique family circumstances, which will change over time, so that you can keep doing this throughout your lifetime and changing dynamically according to how your circumstances change and what the markets offer. That's what we mean by dynamic. And notice, in terms of probability of success here, even the end of portfolio is only a 76% chance of making that. So now how would you make this work with less of the red line? You can lower risk, or you can change any of your profile numbers. That will make it easier with less risk to get that red line of running out of money up higher and higher, and less chance of it occurring. And you could also change the tail risk percent. Next slide. All right. Now, this is an example of the dynamics. Notice this is at about 59 years old. What path your actual outcome is going to take is unknown. The highest probabilities are around expected wealth. Once you've got these bad red possible outcome, if you end up there. And if you end up very high at the upside potential, the top 5%, now that would be great, but that probability is only 5% when you start. So what we're doing here as an example is, if you land exactly on expected wealth, you can create a schedule of a risk return profile by adding another instance. And here it's done with lowering risk to 44% conservative and 56% moderate. So you see, if you end up on that wealth level and you're pretty happy there, why do you want to risk going down with any sizable probability to the red line? But notice the red line's much higher now. As we've reduced risk, means the band between, or the distance between, the green and blue and green and red is now narrower. So when you think about target date fund, that is a strategy offered in the marketplace to say, we're going to use a mechanical rule to lower your risk over time by moving from high concentration of equity, a lot less in bonds and almost no cash, to slowly moving towards bonds and then towards cash. So when you're actually, years could be like 5 years before your goal, you're in all cash. And we know in the last decade or so, cash has been returning virtually zero. So that's not taking into account what future market conditions look like. Plus, doing that in one fund that's a small percentage of your total net worth, why not do it for your total net worth? And based on the path of the way outcomes are occurring and your goals being achieved or not, you may want to change at any point in the future what risk return dynamics you take from that point on, given your goals. So here's an example of a plan shift at 59 years old, when you're still ahead of that's at the first retirement in your family, and ahead of the second. So even in terms of fiduciary responsibilities, if you're in a very good position to achieve all your goals, why would you want your client to take the risk of ending up broke when you can lock in a relatively high, substantial portfolio that will meet all your needs? This portfolio optimization engine is looking at your portfolio relative your strategic asset allocation or benchmark plan. And it first takes all the Morningstar dimensions of risk. There's 56 of them. So we're not only talking about the percentage of cash, bonds, and stocks, but drilling down into your bond portfolio in terms of what's the credit quality of it. Does that match my benchmark? What's the maturity or interest rate risk in there? Does that match my benchmark? How diversified am I across sectors and international versus US? And if we go down into the stock portfolio, how do we compare to our benchmark, our existing portfolio, in terms of the stock portfolio composition, in terms of US, non-US, in terms of value, blend, and growth composition, in terms of all the risk dimensions associated with sectors? Am I way overweight a particular sector like technology or not? I want to get towards the benchmark. That is pretty much the most diversified, best risk return trade-off that you have chosen to achieve. So what we're going to do is minimize those deviations from the plan benchmark, subject to all liquid and illiquid assets and liabilities across all accounts simultaneously. And simultaneously we've already picked a plan that we are comfortable with that maximizes our utility or satisfaction for all our goals and regular spending versus saving. What is available here within this process, which is hard to find typically, is we get to analyze the portfolio and say what securities are missing anywhere in our accounts that can bring us closer to our plan benchmark. So our optimization process and engine will do an optimization and then look and analyze it and say, you really want to reduce your growth exposure in your stock portfolio and have more balance between value and growth as your plan does. But I don't have enough growth or value in each of the large cap, mid cap, and small cap. So our screener will show you the things that can improve, and you can add it to accounts very simply, and then re-optimize. So you're going to stop the process when you can't get any closer to your benchmark plan. But that doesn't mean we're saying that's what you should always do. You probably should if you have no special information about individual securities or anything else within your net worth. So tactical trades can be done here merely by saying, I want to overweight Exxon, and I'll add it to my portfolio as an opportunity in an account that best fits where I want to have it. And then I'll say, remember, I have Exxon in my big index fund, but I want to overweight. So I'm going to say, by how much? Well, you pick an amount, $20,000 as an example, and you put a hold on it. So the optimizer will work around that as a given. The other very important thing is taxes are a huge drag on wealth accumulation. So tax location matters. You want to take your high dividend and interest securities and put them in tax deferred accounts, and then take what might have been in there that has mostly capital gains and low to no dividends, and get that in your taxable brokerage account with very simple constraints to put on your portfolio, like I don't want any of this cash money market fund in my taxable brokerage account, and then re-optimize. And it's just going to move that over to your tax deferred accounts. And at the same time, it's going to be putting your high interest rate account in your tax deferred. You'll see other, like international funds, tend to have high dividends. So you want to put that also over. And the easy way to do it is just say, I don't want any, all right, in a particular account. And the optimization will move it over. But you have to leave what you want in the taxable account. And that might require just adding the opportunity to invest in some of the low capital gains aspects that you had elsewhere. And the optimizer will just do it for you and tell you how much you have to move for each security from all accounts in both directions. So you can do these tax efficient, tactical, and strategic asset allocation strategies. You're going to implement them with position sizes and constraints. But what you'll be doing is maintaining intended risk exposure for which you're compensated sufficiently for while minimizing unintended or uncompensated risk exposures in your portfolio, your entire wealth portfolio. Next slide. Investment process. Kind of described how we picked a portfolio strategy in conjunction with all your goals and profile aspects. But what happens next year, next month, 2 years from now, 3 years from now? Things change. Your personal circumstances may change. Your goals may change as your family has been evolving. Well, how good have we done up to this point in the future? That requires us to measure performance. And performance is your portfolio relative to your strategic asset allocation or benchmark performance. So we get dynamic feedback. We get the performance. How am I doing? Why did I miss a goal? Or why did I perform way better than expected? And the dynamics are that over time, everything really changes. Your net worth is changing. Outcomes are occurring. Not what you expected necessarily. That's unlikely. It's going to be an outcome from that whole probability distribution of outcomes. Where do you go from there? What expected wealth and risk trade-off do you want from that point on? So you can change it. Your personal circumstance can change. It could be health. It could be you did developing fantastic human capital through work, so you can save more and invest more, even if you could even spend more. Your financial goals may change. As you achieve greater accumulation of wealth, you may want the bigger house. You may want whatever. And if you're underperforming your goals and intentions, well, you can look where you can cut back so that you can still achieve a comfortable retirement. So you always want to be, but you want to do it with your choice of investment objectives that comes from picking your future probability distribution of net worth with its risk trade-off. So significant changes require revising planning and the portfolio optimization process. Next page. So here's what a disciplined wealth management process looks like. And it's different than what an asset manager would do. An asset manager won't have this lifetime wealth planning to this extent. It will have a subset, and the subset is typically something like, here are the personal preferences and goals and some other things about the person, but then it'll have a separate box down below that is, what are the capital markets offering? And then go into an optimization decision. So they'll have a much smaller set of goals and opportunities than we have here, and they won't be decided together with potential trade-offs. So in lifetime wealth planning, we're putting all those two boxes together at once to figure out what the strategy of lifetime wealth planning should be. Then we put it through our optimization engine. And we get some results. And even there, we're still working with it. If there aren't securities in the portfolio we need, we'll add them there and then re-optimize. When we're done and execute the plan, then we want to monitor how it's performing over time. So we need to do our performance measurement. What are the sources of performance, which we call attribution? They're all going to be based on portfolio versus benchmark. We'll review financial health, and with all that monitoring of deviations, we'll see, has our portfolio drifted further away from our benchmark? And then we take all that information and bring it back, the dynamic feedback loop, to both lifetime planning and portfolio optimization. So by bringing it all the way back, we can review our personal circumstances, the trade-offs available from the market, what our current net worth is, and see what our investment objectives tell us about our preferred choice that will reveal our preference for a new solution, given what has occurred since my last one. And then go through the process again and feed it back. Next one, slide. All right, here's the important concepts to always keep in mind when you're developing this investment and planning process. What you want to look out for is the drag on wealth accumulation. There's a nice book about why there aren't more billionaires. If you started in the early 1900s, they should be all over the place. What is keeping that down? Well, the first is unnecessary costs and fees. So when I look at fees and I run this example for just 30 years, the average of all fees is about 1.68%. And over 30 years, you lose a third of your wealth to that. So notice 3 million becomes a net 2 million. Okay? That's big. Now, if you think that's bad, try not minimizing taxes and compare that 1.68 to overpaying taxes by 10%. That's going to crush you. So you got to do the best you can in all places. Certainly, what people tend to do and want to do is smooth out their consumption or spending over time. And we use techniques to do that. No one would be, well, I shouldn't say no one, but a very few people would be able to save enough and buy a house for cash. There'd be a lot fewer houses in the country. All right. So what we do is, in order to have that for a long period of time thereafter, what do? We borrow. We get a mortgage on a secured asset. And a mortgage is very highly levered. Like a typical one that's super low risk to the lender is you put 20% down, but you're able to put all the way up to 0% down, depending on the mortgage type. Well, that means if your house drops, if you had a 0%, I'm saying no mortgage at all, and your house dropped $100,000 in value, you liquidate it and you've lost that $100,000. If you lose your job in a recession, can't make the payments, and your house value is down, you lost all your equity mostly. So that's a hedge fund investment with a lot of leverage. And so are all banks, hedge funds with big leverage. Okay. So in terms of smoothing your consumption, that's a great opportunity. Okay. Especially if you do with a low risk of ever defaulting. And it also locks in an expensive part, inflation. A lot of people chase inflation to buy a house. They can't save enough for the down payment as the house price goes up. And mortgage rates go up, so they can't qualify. So the soonest you can get into a house, if that's your goal, do it. And then your house value will go up with the rest of house values. You'll increase your equity to be able to turn it over and buy another house or move to another state where you have a better employment opportunity. So that's a way that we get more consumption now by borrowing and spread it out over a lifetime. An example of smoothing consumption for more in retirement, we put money in tax-deferred accounts. So it can grow tax-free. So you'll have more to spend at retirement. Other savings beyond tax-deferred, just an investments in, if you can save and put it in even a taxable account, you're still going to grow. And that's how you smooth out spending over time. Behavioral bias are a problem. But the way we're going to manage that in WealthFluent is be disciplined in the investment process. If we look at data objectively and then how that looks to you to make choices, then you won't have all these behavioral biases. One of the worst ones is what I think of as envying other people. Seen it many times where tech is doing great in, let's say, 1898, and my neighbor is making a lot of money, so I'm going to move all my investments into tech. The bubble burst in 2000 and lost 80% of wealth. Not well diversified. By showing you diversified alternatives, you'll make the right choice. So a disciplined wealth planning and management process is essential. A lot of people, what I guess would be an example of a behavioral bias, is an optimist looks at a glass of water as half full and a pessimist half empty. I just call it a half a glass. Think about approaching your financial decisions that way. Now, most investment products cannot offer you more than the market already does. But Wall Street will certainly, you tell them you want something, they'll give it to you. but the cost of creating it can be more than its value. So annuities are a prime example. Annuities don't sell very well in this long period we've had with interest rates very low for almost a decade. That short rates were pretty much zero. And when the long treasury bond, 30-year, was 1.5%. I take a look at what annuity fees are. They're 1.75 to 2%. They're higher than what the long bond is yielding. And everything else short of that is yielding a much less. So how is it possible to make sense to buy annuity under those terms? In fact, I did a little example, and the actual yield to maturity was 0.66%, less than 1. So your fees are more than overcoming what you're being offered. So what's the smart thing to do? Create an annuity. You can do it with several treasury bond funds. And the advantage is, as market conditions change, so for example, people think that if I buy an annuity that gives me $2,500 a month, but great, I can't outlive that $2,500, right? It'll be there till I die. Well, what's the problem? If we have an inflation and rates go up to 20%, which I observed in my lifetime in 1982 and 1. So what's the value of an annuity that only has a 0.66% rate of return? It could be near zero. You can't purchase much with that $2,500. That adds huge interest rate risk to it. That's why you have to manage it as part of your whole bond portfolio to see whether it should enter or not at any given time. Because we have the risk dimensions to see what could happen to its value. Unbundling and managing risks is one of the great breakthroughs available since the early 80s, but isn't applied much for individuals and clients. So if you take the bond market alone, just as an example, it's got interest rate risk, default risk, and prepayment risks. What you get in the treasury bond market is pure interest rate risk, no default risk, no prepayment risk. What you get in corporate bonds is interest rate risk plus default risk. What you get in mortgage-backed securities. These are the three largest sectors. For mortgage-backed securities, you get interest rate risk and prepayment risk. Well, in the last 10 years, with a very low positive slope of the yield curve, as I said, 0 to 1.5, or an inverted yield curve that we've had in the last few years, or a flat yield curve, is saying what's the compensation of getting for moving to higher and higher maturities? 0 incrementally or negative. You divide by the volatility of that. First, you subtract the 1-month treasury rate, divide by the volatility, which is increasing over longer maturities, and you get expected Sharpe ratios that are 0 to negative. Why do you want pure interest rate risk in your portfolio? You'd like to eliminate it, but you might like the default spread during that period of time. You might like the prepayment risk compensation. So what institutional managers do is they short treasuries to get rid of the interest rate risk. Now, that's a little complicated for individuals to do, but knowing that you want to get to that point means you can invest in short duration, investment grade bonds. So remember, the performance here is based on those spreads between, or expected compensation, I should say, for default risk and prepayment risk. So you can still get that with no interest rate risk with the products that are already out there where they do it for you, the hedging of interest rate risk out. So what we've had in the last 10 years is we don't want any of that interest rate risk, pure interest rate risk from treasuries, but we still may like those other strategies. Now, a portfolio manager in the core fixed income space, most of their performance is associated with underweighting treasuries and overweighting what we call spread products. The biggest two spread products are mortgages and corporates in the total bond market investment grade index. So on average, in the long run, if you're a long-term investor, you're going to reap those benefits. Expectations will be realized on average, and you will outperform the benchmark just by your sector allocation decision. And that is doable by anybody. There's no special information to that. But if you have market analysis tools like WealthFluent provides, you can see where the highest Sharpe ratios are coming from, expected Sharpe ratio. Now, you still need to include correlations, and that's in there too, but you get quick insights into which are the ones that you'd expect to be highest rated, highest allocated in your final portfolio. Now, you can do the same thing with stocks. I was very involved in stock index futures becoming an opportunity in the marketplace in 1982. And that lets you separate market risk from non-market or industry and firm-specific risks. So if you think you've got a bunch of great alpha opportunities in your ways of picking securities, but you don't want to take on the market risk, which you're getting less compensation for, you just short stock index futures contracts to take out to a level that takes out the beta or response to the whole market. Then you can lever that and you'll have a much better expected return per unit risk strategy. Well, individuals can do the same things without using futures. The idea is unbundle the risks that are in every security, pick the ones you don't want much of because they're not offering you sufficient compensation, and take the ones that do. Investment discipline is so important. That's what I mean by being unbiased, objective logic. So you need client information sufficient so they can determine what their preferred expected wealth versus risk trade-off is, given all their goals and personal preferences and personal circumstances and retirement decisions, et cetera, et cetera. That way you can observe a lifetime probability distribution of outcome. All right, so now you're really looking at risk objectively. Most planners will pick a number, or they call it a simulation or something else, to give you an idea that if expectations are realized and you choose this portfolio, you'll be able to make your goals. But that's not showing you all the risk that could happen of not making it. That's why we need a simultaneous set of decisions. And investment discipline requires you to have fiduciary responsibilities. Now, that's a bit of a legal term, but I would always act in the best interests of my client, whether that was the law or not, for the circumstances of this mandate. Finally, downside risk management. We hate negative income outcomes more than we like an equivalent positive income. That's outcome. That's what's called risk aversion, and that's also logic. So we want to avoid as much as possible the risk of ruin, which is ending up broke in real terms, and losses of standard of living. So downside risk is more important than upside potential. But an individual looking at those possible outcomes can make that decision for themselves.
Thanks for your time. Excited for you to start using WealthFluent with clients.